Hey, what's up, everybody? This is Andrew from Dividend Growth Masters, and this is going to be part 2 of our financial statement analysis series. In the last video, we went over the income statement, going over most of the line items on a line item basis. And in this video, we're going to do pretty much the same thing except with the balance sheet. So we're going to stick with Apple as our example. Okay, let's get into it. Now, the balance sheet differs from the income statement in that it deals with a company's assets and liabilities versus the revenues or expenses, like the income statement. So the way the balance sheet is reported is there's usually two dates. There's one date for the most current period, and then the date as of year end. So the balance sheet is really divided into three different sections. You have your assets and your liabilities, and then your shareholders' equity section. And this follows the basic accounting formula. Assets equals liabilities plus equity. So the balance sheet is pretty much, the assets and the liabilities are pretty much divided into what are called current and non-current. So you have your current assets and your non-current assets. And you also have your current liabilities and your non-current liabilities. Now, this basically refers to when those assets or liabilities will be used or paid out. So current assets are those assets that will be used up within 1 year, and non-current assets are those assets that are going to be there for longer than a year. So examples of your current assets would be things like your cash, your inventory, your receivables. Examples of your non-current assets would be stuff like your office buildings, your land, stuff like that. It's a pretty similar thing with the liabilities as well. You have your current liabilities, like let's say your salaries payable to your employees. You have your accounts payable to your vendors. And then you have your non-current liabilities. So these are things like a mortgage or debt with the bank when they loan you money. And the reason we have these two different classifications between current and non-current is we want to see what the company has due in the near term versus the long term. So let's go over the asset section of the balance sheet first. So the way the balance sheet is presented is in terms of liquidity. So the most liquid assets are the ones that are presented first. So you have things like your cash and your marketable securities. So marketable securities is just basically a fancy word for investments. And then you have your accounts receivable. So accounts receivable is basically IOUs from your customers. Most customers don't pay in cash, so they pay on credit, typically between 30 and 60 days. So that's what that is. And as you collect on that balance from your customers, this balance will go down. And then you have your inventories. Inventories are exactly what they sound like. So in the case of Apple, inventories would be things like their smartphone inventory, the iPhone inventory, iPads, Macs, that sort of thing. And they also have a smaller balance of other assets, like vendor, non-trade receivables, and other current assets. Whenever you hear the term receivables, it means that the company is owed something. So it could be a vendor receivable, or it could be something like a tax receivable if they have a tax return from the IRS. So after you go out of the current asset section of the balance sheet, you'll go into the non-current assets. So again, these are assets that will not be used up within 1 year. So you have things like your marketable securities. So these are your long-term investments. You have property, plant, and equipment. So this is basically a very fancy word for the equipment of a business. So it includes stuff like any land you own, any cars that you own, any buildings, any office furniture, any computers, that sort of a thing. So those are the most common types of non-current assets that you'll see. So let's go into the liabilities section. So the largest current liability for most companies will be their accounts payable. And these are payables to the company's vendors. So this is basically the vendors extending credit for the company. Typically, accounts payables are paid within 30 to 60 days, just like accounts receivables. So one item that you might see sometimes with a technology company like Apple or Microsoft is something called a deferred revenue. And that's basically when a customer pays for a good or service up front, but the company hasn't delivered that product or service to the customer yet. Apple also has some commercial paper and some term debt. So those are just fancy terms for debt that they have, borrowings that they have from banks and investors. So these are some of the more common types of current liabilities. We also see things like salaries payable, marketing commissions, stuff like that. And then you get into your non-current liabilities. So these are liabilities that will not be paid within 1 year. So you have things like your debt, and they also have a bunch of other liabilities that they group together into one category. So if you want to learn more about that, you can scroll through the footnotes of the financial statements. Some other common non-current liabilities include things like mortgages, or sometimes there could be environmental liabilities, or any big lawsuits that they have, and they have to accrue for that. So that's basically a quick rundown of the balance sheet. So the balance sheet is basically showing what assets the company owns and what liabilities they have on their books. And the reason this is valuable is because, one, you want to be able to see what kind of assets the company owns and what assets they can use to produce more sales. And you also want to evaluate how much debt they have on their books, because obviously too much debt on any company's books is not good. Now, it's important to keep in mind that the balance sheet presents all this information at a point in time. So it's like taking a picture, if you will. So it's showing the balance sheet as of March 30th, 2019 and September 29th, 2018. So if you wanted to measure all these accounts again the next day, let's say on April 1st, then all these accounts would be different. Now, the balance sheet is one of the more useful financial statements that you can use to analyze a business. Hopefully this tutorial was helpful in helping you understand how the balance sheet works. If you liked the video, please give it a thumbs up and subscribe to my channel. And if you want to learn more about dividend investing or financial analysis, don't forget to visit my website, dividendgrowthmasters.com. And I also have a financial statement analysis course. It teaches a lot of the same information that you saw here, but in more detail. So I'll include a link for that in the description below if you want to check that out. I'll see you guys next time.